Are you wondering whether to invest in a mutual fund or an ETF? Both can help you grow your wealth, but they work differently. In this video, let's explore what makes them different and how to choose the one that fits you best. First, let's talk about mutual funds. A mutual fund pools money from many investors to invest in a basket of stocks, bonds, or other assets. You don't trade it like a stock. Instead, you buy or sell your units once a day, after the market closes, at what's called the net asset value, or NAV. Many mutual funds are actively managed, which means professional fund managers decide what to buy and sell, aiming to outperform the market. And if you like the set and forget style, mutual funds let you set up automatic monthly investments, often called SIPs. To summarize, the key points are: trades only once per day after market close, often has a minimum investment amount, can be actively managed or passively track an index, easier to automate investments with SIPs. Now, what about ETFs, or exchange-traded funds? An ETF also holds a collection of stocks or bonds, usually tracking an index like the Nifty 50 or the S&P 500. But here's the big difference. You can buy or sell ETFs anytime during trading hours, just like you would with individual stocks. This means the price of an ETF changes throughout the day based on supply and demand. ETFs are usually passively managed, so they often come with lower fees than actively managed mutual funds. And instead of a minimum investment, you can start with the cost of just one share. ETFs are also popular for investment in commodities like gold and silver. If you're looking to gain exposure to international markets, there are ETFs that track stock indices from other countries. Some examples are MAFONG by Myri Asset, which tracks the NYSE FONG Plus Total Return Index, or Nippon India ETF Hang Seng BEES, which tracks the Hang Seng Index. Next, let's compare them side by side. Mutual funds trade only once a day at the NAV, so you can't react to intraday market moves. ETFs trade anytime during market hours. When it comes to investing, you can invest in mutual funds directly from websites of the respective mutual funds, or a mutual fund distributor. You need a brokerage account to invest in ETFs. When it comes to fees, mutual funds often have higher fees if actively managed. ETFs usually have lower fees, especially if they track an index, though you might pay brokerage fees and face bid-ask spreads, which slightly increase costs. What is bid-ask spread? When you buy or sell an ETF, stock, or other security, there isn't just one price. There are two. There's a bid price, what buyers want to pay. And there's an ask price, what sellers want to get. The difference between them is called the bid-ask spread. Let's take an example. If the bid is 99 rupees and the ask is 101 rupees, spread is 2 rupees. A smaller spread usually means the asset is easier and cheaper to trade. Why the spread matters? Smaller spread means lower cost to trade. Larger spread means higher hidden cost, often in low-volume ETFs or stocks. Before you buy an ETF or stock, check the bid-ask spread. A narrow spread usually means it's easier and cheaper to trade. Coming back to comparing mutual funds and ETFs, it's easier to automate monthly investments in mutual funds. Since ETF prices fluctuate throughout the trading day, it can be tempting to time the market, making it harder to stay committed to regular monthly SIPs. Mutual funds usually have minimum investment requirements, at least 500 rupees. With ETF, there is no minimum investment requirement. You can buy one unit of any ETF. Next, the mutual fund market is more mature, with many established fund houses and a wide range of options to choose from. ETFs are catching up, though. At the time of making this video, there are about 263 different ETFs you can choose from. When it comes to liquidity, it's typically less of a concern with mutual funds. Whereas, certain ETFs, especially those tracking niche or low-volume markets, may experience liquidity challenges. Liquidity means how quickly and easily you can buy or sell an asset and turn it into cash without significantly affecting its price. Higher liquidity means you can buy or sell large amounts quickly, Prices stay close to the asset's actual value, NAV. Lower liquidity means harder to trade large quantities quickly. Prices might fluctuate more and move away from the NAV. Mutual funds and ETF, both are great tools, so how do you choose? If you want convenience, don't care about real-time trading, and prefer automatic monthly investments, mutual funds might be right for you. But if you like flexibility, lower costs, and want to trade anytime, ETFs could be a better choice. Then there's also a blended approach, using mutual funds for regular investing and ETFs to target specific sectors or themes. I personally do this too. In the end, it's all about what fits your style. If you found this video helpful, give it a thumbs up and subscribe. Which one do you prefer, mutual funds or ETFs? Tell us in the comments. Thanks for watching and see you in the next video.